So far, we are clear with the concept of simple interest rate, compound interest rates, then the difference between nominal and effective interest rates. Now, in the second part of our video, we are shifting our focus to understand again very important concepts to finance and economics. That is the concept of net present value and its use. Okay, and also we will be emphasizing on how to compute the net present value of an investment, be it a real investment or financial investment, and then how to interpret the results. Okay, and how to further use these results for evaluation of the investment alternatives. Like in one of our key objective, we had mentioned that we, by the end of these videos, we should be able to make a choice and evaluate two set of investment alternatives, like which one to go along with. So we are shifting our focus towards that now. In the time value of money concept, when we were discussing, we have seen when we are trying to calculate our future value from given set of present values for a particular investment or particular asset. Okay, we have to calculate the respective cash flows over time for period 1, then for period 2, and simultaneously up to whatever periods are given, right? And likewise, now think of two assets. Okay, you have two different investments, all right, and you are supposed to compare the two different streams of cash flows which are associated with them respectively. Now what you will be thinking of, given what we have discussed, is that individually, first of all, calculating over the time their cash flows and then getting them both in a single time frame of reference and comparing them respectively, right? But in principle, any period could serve as the basis for comparison, right? But however, it's very natural to use the present value as a more intuitive reference. All right, so what the concept of present value tells us is that how much the future cash flow, okay, are worth to an investor today. So basically the concept of present value is answering this question, that how much the future cash flows are worth to you as an investor today. Now you can recall this from the formula which we have already discussed in our previous discussion, that future value is equal to present value times your interest rate, right? I mean present value plus interest on the present value, right? And likewise, what happens, I mean using this approach of present value, is that it allows us to compare the stream of cash flows into a single value that is sitting today, right? Now recall that in single period case, when we are talking about one period case, the expression which was connecting a given present value with the future value was given by this, right? Of course, using the interest rate as a price of money over time. Interest rate was being used as a price of money over time, and we know why interest rate reflects the price of money over time. It's essentially because of those three factors which we already discussed, that is your inflation expectations, your risk element, and the first one was referring to the point that was I'm not able to recollect, let me think. Yeah, so this was basically referring to preferences, right? Yeah, so the time preference which we were reflecting with the real interest rate, right? So these were the three key factors which we had mentioned or discussed in at the outset, that what was driving the price of money. So it was the nominal interest rates, and these were being driven by your preferences, your inflation expectations, and the uncertainty or the risk element which is associated, right? And now we could express or rearrange this simple expression which we are using for one period case to compute the present value for two period case, okay, as this, right? So we can rewrite this expression as PV is equal to future value to that of this 1 plus I, right? This ratio will give us simply for the second period, right, two period case. Now in this case, the present value is the future value divided by the gross interest rate. Basically this is the gross interest rate, right? So another way of expressing this is 1 divided by the gross interest rate, as a factor that multiplies the future value. So this factor here is called the discount factor. Now this 1 upon 1 plus I, this what we call this is discount factor. Always remember, because this expression is being divided by this, right? It's being discounted here, so that's why it's being called discount factor. Compound means over the time ahead you are going further, right? For the future you were predicting, that was compounding. Discounting means that from future you are predicting the present value, right? You are using future value here, trying to get the present value by discounting it with this factor, right? So that's why it's called discounting factor. Now the future payment is discounted using this factor, and in the multi-period case we have a very parallel expression to this, which is this one, right? So how to understand the multi-period case? Now imagine that you have cash flows over time period. Say for example, this is our time axis, so this is our time axis, okay? And over the time what you have, these are the different time periods which have respective cash flows associated with them. So let us say that we have, let us imagine that we have a series of cash flows, I mean sitting next to each other over the periods. This is cash flow 1, this is cash flow 2, this is cash flow 3, this is cash flow 4, this is cash flow 5. These cash flows are from the respective investments which you already have lined up for you, okay, which are going to get you a return in the future. So you already know about what potentially I mean you are expecting in terms of the return from them, the cash flow, okay? So what you essentially try to do here is that, so there is a cash flow here and another one here, right, in period 2, then another one here. Suppose that we want to add them up, these cash flows we want to add them, and we cannot add, I mean them simply together because they are sitting in different time periods. I mean intuitively if you think like first thought, without going for any rationale, would be that okay, if I'm interested to get the total value, that how much they value today, I may simply add these, I may simply consider adding these and this will give me the value. But no, because see, this cash flow is sitting at time period 1, this is sitting at time period 2, this is sitting at time period 3. Your T factor plays a very important role in terms of deciding your outcome, because discounting factor is raised to the power T here, right? So if T is varying, your cash flow which is associated at different time period, which is sitting at different time period, will be getting you a different value, right? What we can do is to compute the present value of each of these cash flows, right? For each respective cash flow we individually first get their values, right, and then try to add them up. So at once they are sitting here in period 0, we can sum them up and then compute what's called the present value. The formula is given here, right? So this formula can be used to calculate this. Now we see that each cash flow is discounted by the corresponding interest rate. So respective interest rate which is going to be there for each cash flow, it will be, discounted with that factor, right? So this boils down the formula to this, which we already have mentioned here. And you can see that when the cap T goes to infinity, now say for example this T, okay, if it tends to infinity, what will happen? So this term will go to 0, right? If this goes to infinity, right, this will tend to 0, this term will tend to 0. So the present value collapses to this expression here, right? That is the project or the investment that pays a constant stream of cash flow, okay, forever. The present value is compounded by dividing the individual cash flow by the interest rate. So this is the expression which helps us in the case when our cash flows are going to be constant. So in other words, what we should note here is that future cash flows are discounted to the present value at interest rate I, right? And one of the main application of this concept of present value is to compare the investment alternatives, like I have been mentioning in the initial slides also, that we will be ending up with the comparison of two different investment alternatives as well. So this is where this concept will be very handy. And here in the series of discussions which we are going to have later on as well, so we'll be talking about investment alternatives, investment that are basically related to financial investments. Okay, but the concept broadly you can relate it even in terms of the real estate sector also. I mean, in terms of the real investments. Okay, for example, comparing different alternatives in the housing mortgage market or any other infrastructure project, etc. It can be used in any of those domains in terms of the applications. Okay, so even for the two different technologies or two different projects, if you want to assess, okay, so different machinery for a certain product area, etc. So it can be used to draw comparison for that as well. And the same concept will be applied to evaluate the alternatives that are associated with the real investment. Now, investment alternatives can be assessed by comparing their net present values. Okay, so how to go about comparing the alternative investments? So NPV concept helps us in assessing the investment alternatives. All right, and we are going to see that that NPV, okay, it allows for the fact that some cash flows may be negative and others positive, right? And typically what happens is that when we have an investment project, there is an internal negative cash flow associated with the initial investment, because say for example, you as an investor, you are investing $10,000 in a project. Okay, you invested, I mean, in terms of the cash flow, think in terms of the cash flow, it went out from your hand, right? So it's negative, right? That cash flow is negative in real sense. It went out from your pocket. So you as an individual, you are ending up with a negative 10,000, right? When you are investing at the outset, right? So when you have an investment project, the initial negative cash flow is associated with the initial investment, right? And what happens, this is followed by a positive cash flow. Once you invest 10,000, say for example, you invested in on some machinery, etc., and that machinery over the time now is getting you the revenue. Okay, you are manufacturing products using that machinery and that is getting you the revenue. Say for example, after 1 year you sold the products worth 10,000 which were produced using that machinery. Okay, 100,000. Okay, so definitely this differential is going to be positive, and you are having a positive cash flow in the next period, in the period 1, say for example. Okay, this is in the period 0, this is in the period 0, right? So this is one of the very common observation, right? This happens actually. And then this is followed by a positive cash flow. I mean, initially you started with a negative cash flow when you initially invested, and then you are having a positive cash flow, assuming that you are able to sell your product, etc., or your investment is actually getting you a return, right? So we can see that the NPV, it's critically depending on the interest rate, right? Why? Because if the interest rates are going to be higher, what will happen? So higher interest rates means our present value will fall down. We have seen even in the formula, right? What was our formula? Our formula was that PV was a function of the cash flows 1 plus interest rate raised to the power time, and this was sigma t equal to 1 to t, right? Say for example, our interest rates are going up. What it will imply, this denominator is increasing, which implies this will go down, right? So our PV of the future cash flows is definitely going to get affected inversely. So this relationship, you should be very clear that your PV is inversely related to the interest rates, right? So your future stream of cash flow will tend to decrease if the interest rates are going up over the time, right? So the decision is that investment with a higher NPV is most profitable. It makes sense that if your NPV, okay, if NPV is higher, I mean, in other words, what we are saying, if your NPV is higher or interest rates are lower, right? So our investment will be the most profitable, right? It's best in our interest to invest if the NPV is highest. So this is the criteria which is chosen. All right. So and the interest rate which is offering us that value of NPV which is maximum. So our maximum NPV at the rate of I, that particular interest rate, okay, I mean at a given interest rate, where the NPV is maximum, that is something which will be the most profitable point for a business entity, right? So this is one of the key takeaway, and here interest rate should commensurate with the level of risk of the associated investment, right? So basically here I is accounting for what, because we initially have been talking about that I is reflecting the expectations, right? The inflation component, right? Again, the inflation expectations and the uncertainty element. So this I is accounting for those factors, and specifically the risk associated with your investment is being reflected in terms of the changes in I. So investment with the higher NPV is most profitable for a given interest rate, which is I. All right. So given this, while alternatives that imply different level of risk, which may be there, right? So we can have this as a measure for comparison. Now we discussed this concept of NPV and its use as a tool, how to go about comparing a set of investment alternatives, right? Now let us shift our focus to the concept of future value for a series of cash flow. Okay, so especially when we are considering a multi-period case, all right, so we are going to discuss the concept of future value, which refers to the sum of cash flows for an investment at the end of possession period, okay, and typically the end of maturity of the investment, which we have been mentioning with the time period T. So in the multi-period case, what happens if we draw a timeline similar to the one which we had drawn earlier? So let's take a similar expression. Okay, let's say that we have a multi-year representation given, okay, for the investment multi-period case. So this is period 1, this is period 2, this is period 3, this is period 4. Okay, so given multi-period case, if we draw this timeline which we have here, right, up to period 4, so we say that we have several time periods and cash flow sitting on each of these periods, right? CF1, CF2, CF3, CF4. Now in order to compare, we need to bring them into a single period, right? And this time we choose to bring them into the future. Now right now, what is our objective? Initially we were trying to bring them all to a single period and get the PV, right, in the previous example. But right now our objective is opposite. Our objective is to get to the future value based on these set of cash flows which are sitting at their respective time periods, right? How to go about that? You know that you are going to have the cash flow in period 1, 2, 3 and 4, these cash flows respectively. Now you are interested that what is the future value of these cash flows which are sitting at different time periods. All right, so we will be bringing each of these into the future. Now once they are there, we add them up. So individually what we are going to do is that we are going to get their future values. So, and once the future values are there, then we can add them up. Not directly adding them up will solve or serve our purpose, right? So the formula for the future value in case then would be simply taking each individual cash flow, capitalized into the future, right, where the corresponding number of periods between where the cash flows is sitting right here. For example, this is our final period. Say for example we are interested till period 5, so we are calculating across all these time periods individually, and then we are going to add up, right, add them up together for the period 5. So in particular case, that cash flows are constant, okay, like in previous case also we said that what if we have a case where our cash flows are going to remain constant? If this is equal to this is equal to this is equal to this, right, all these are going to be constant. What then the formula boils down to this expression which we have here, that is our future value is the product of cash flows which are constant to that of this factor which we are basically compounding, right? This is not in the denominator, it's like a compounding factor only, right? So this expression I request you to please make a contrasting comparison with the expression which we had under constant cash flows for the present value case. Okay, and you will be able to contrast these concepts under constant cash flows, and you will see that the two formulas are very much related. They are completely intertwined if you observe carefully. Okay, so in any case, so in this example one which I am going to take up, so let us consider that we are interested to know the future value of a payment of $500,000, $5,000 today, and a stream of 15 consecutive yearly revenues of 500 each if you use an interest rate of 5%. Okay, so we are given this problem. We are interested in the getting the future value. So there is a simple hint to solve this problem, that you simply have to use the future value with constant cash flow approach. I would request you to please work out this problem, pause the video and get the solution. Now I'm assuming that you already have attempted the problem. So how to go about it? We simply have plugged the values into the expression, if you observe here. So like we had discussed, that in the period 0, when you are investing the $5,000 initially, it's a negative cash flow, it's going out from your pocket. But after that period, whatever cash flow is coming back to you, it's positive, right? So that's why this negative is there with the initial cash flow which went out times the interest rate to that of the period, which is 15 here, right? Because the stream of 15 consecutive years is there, right? Plus the factor of the constant cash flows, right? This factor. So that's why we have used this expression here, and we get the answer here. All right. Another very fundamental concept to finance is the concept of internal rate of return. Now, so far we have already seen that how to go about calculating the NPV, right? And we have already discussed that NPV can be calculated by simply bringing the stream of future cash flows into present by using a discounting factor, that is 1 plus I, right? And so computing the NPV requires the knowledge of both cash flows and the interest rate, right? The duration of these flows that is there, and the interest rate which we have used, that is I in the expression here, right? So it requires the value of both. But notice that we could have had set the NPV to 0, all right, and ask ourselves that what is the constant interest rate for which the net present value is 0. Okay, what is the constant interest rate? What is the constant interest rate for which the NPV is going to be 0, right? And the interest rate at which the NPV is going to be 0 is what we call as the internal rate of return, right? So setting this same expression equal to 0 will give us an interest rate which we call as the internal rate of return. All right, so it has a very important meaning. Why? Because it's basically the interest rate that this particular project, the one which has associated these cash flows, will give to the investor, right? So in other words, what does it mean? That the IRR, or the internal rate of return, will be the opportunity cost of investment alternative. Now, say for example that you have project A and B, and you know the IRR associated with the projects. The value of NPV is 0 at what interest rate, you already know. So that you can use as a basis for comparing between two alternative investments, right? So investment alternatives that have higher internal rate of return, say for example IRR of A was greater than IRR of B, right? So this is definitely a good to go, right? Internal rate of return is higher for project A, right? It will definitely tend to be better and will tend to dominate investment alternatives like B, or even if a C alternative were there and it had an internal rate of return greater than B but again less than A, then A will be favored investment alternative, right? So this is how you should be interpreting this, right? That it's basically offering relatively lower internal rate of return, so that's why it's not something which we are favoring in terms of B and C over A, right? And also notice that the internal rate of return is the average interest rate. Okay, average interest rate for what? For which the present value of the discounted cash flows equal to the initial payment, or what we have mentioned, that is NPV is equal to 0. But also the internal rate of return is a rate that equates the future value to what? To the initial payment, right? So internal rate of return is the rate or the interest rate that equates the future value of the cash flows including the initial payments. Okay, so practically if I speak, that internal rate of return can be used to evaluate investment alternatives, as it has been mentioned before. In this case, a project that has a larger rate of return is preferred. All right, but in practice the internal rate of return has some drawbacks associated with it as well. The main one among the drawbacks is that some projects may have more than one internal rate of return. So there can be projects with more than one IRR. Sorry, small typo here. Yeah. So this is the drawback of internal rate of return, right? So for them, I mean, if in case you have projects with more than one internal rate of return, I mean, it's not going to serve the purpose in terms of the investment decision making, right? And the second drawback is that the internal rate of return is a constant rate, right? So this is the first. The second one is it is a constant rate. Risk factors can change. I mean, you know that the key three underlying factors which we had discussed, so alteration in them makes sense that your interest rate should also alter, so it's nowhere being accounted for here, right? And therefore it cannot allow for introducing a variation of interest rate, right, over the time. So the concept does not allow for you to see the yield curve, okay, to assess the investment alternatives. Now the net present value of a project using its internal rate of return to 0, right? And finally, what I would like to point out as a conclusion is that this implies that as an investor, you will be indifferent between undertaking a particular project or investing in an alternative that provides a deal which is equal to the internal rate of return if such drawbacks are there, right?